Hello, this is David Lawson with the Lawson Real Estate Team at eXp Realty here in Park City, Utah. At our most recent monthly event, we featured Josh Romney presenting his economic forecast for real estate. Here's the full recording, and we hope you enjoy this fabulous content. Thank you. Okay, as I promised, we're starting at 12:20. So, first of all, I wanted to just say thanks for all your support and coming, and we truly appreciate it. And for now, Intercap and Bert is the lending partner for our team. And I'm just going to turn it over to him, and then he can introduce Josh, and we're going to get started. So thanks, everybody.
So I'll be real quick. Josh here, you're our owner, founder, CEO.
Yeah.
He does all of it. But so he has a lot of really good data about the Utah economy. Real estate in particular that I think can help everybody here. And what do you have, like an hour presentation?
Whatever you want.
About an hour.
Yeah.
And it's probably going to be the most important hour you guys are going to have the rest of the year, in my opinion. And then after, we can actually get you all the data and all the, can we do that? Right?
For sure. I already sent it to you.
Oh, cool. Okay.
So
make sure you sign up over there, and then we'll get you everything in PDF format for today.
Yeah.
With that, Josh, I'll let you take it.
There's Josh.
Okay, thank you guys. So I already sent Bert the presentation, so you don't need to take notes on it or anything. If you want it, just put your email back there. He will email it to you, and you feel free to share it. It's nothing that's not out there in public. So, but hopefully we can share some information that's going to be interesting to you all. I'm going to stay probably at 30,000 feet on most of these issues. If you want to get deep into the weeds on anything, let's just ask me, and I'm happy to have that conversation and kind of get deeper into issues and what's really happening. A lot of this is kind of it's complicated. What's tough is that the economists used to really be able to understand the U.S. market because we were a U.S. market. You know, the market was really based on what's happening from California to New York City. Now we're very much a global market, and things that happen in Beijing and Russia really impact what's happening in Iowa and Salt Lake City. So it's gotten much harder to understand what's happening in the market, but what I'll share is just some fundamentals and things that are happening, why they're happening, and hopefully that'll give you a sense of where we're going and kind of where we are. So with that, I think what's important to understand is what the government has done. Almost everything we're dealing with right now, at least in the US, is because the government went a little crazy when COVID hit. They were nervous, as they should be, because we were headed towards potentially a major depression, or who knows what could have happened. But their response was to throw a lot of money at it. In fact, they threw $5.3 billion, which $5.3 trillion that they normally don't spend into the economy. And they didn't really care where they threw it, they just threw it in. They gave it to people who they knew were committing fraud and asking for the money. They almost didn't care. They gave it to anybody that asked, got money. So it was so that has a real impact. It saved the economy back then. Now we're dealing with some of the consequences of spending that much money. I'll show you. Is there a question? I'll show you some areas where they spent the money. One of the things they really did, and you can see this is the government's purchasing of mortgage-backed securities. This is impacting all of us in this room. So the government in 2009 or so started dipping into buying mortgage-backed securities. And they realized when they do that, it really drives mortgage rates down. So when you have someone buying mortgage-backed securities, it's really going to drive rates down. So you can see when COVID hit right here, they really started ramping up buying mortgage-backed securities. They got really good at it. And what happened? We all saw mortgage rates were driven down. They drove them down so low that we had mortgage rates in the mid to low twos. So really, really effective in terms of getting money into people's pockets. It created enormous wealth in the economy and did some interesting things. Overheated the housing market, obviously, and had what I think is some negative impacts long term, but also some positives. So, but if you think about what got us out of a potential recession or depression, I really think the government's focus was to create a housing recovery, to focus on housing, put wealth into people's pockets so that people were able to refinance, lower their payments, all that stuff. You think about how much money that generates. Instead of paying a mortgage payment, you're now able to buy motorcycles, hot tubs, all those different things that people have because they were saving $500, $600, $700 a month on a mortgage payment that went from $5.5 to $2.5. So really injected a ton of money. Not only did they spend $5.3 billion or $5.3 trillion, they lowered everyone's payments. So just all this cash started coming in the economy. Tons and tons of cash. As a result, now we are having to pay the piper a little bit, right? So we've seen what's happened. And the Fed basically there's a couple theories about why they took so long to pare back. They kept interest rates really low, probably 9 months too long. There's some theories about why they did that I won't get into that are very political. But probably 9 months too long, they kept their foot on the pedal and accelerated the economy even though we were already overheating. And they knew we were overheating. They kept the gas down all the way. And now, instead of taking your foot off the gas and letting it cool off, they're having to put their foot on the brake. So we have the brakes on the economy. The Fed is doing everything they can to really slow down the economy, do everything they can to hamper it, stop the growth, lower employment numbers, do all those things instead of letting it naturally kind of occur because they knew they were too late. So now we're dealing with the flip side of hitting the gas, we're hitting the brakes. And there's some consequences to that. So let's look at what's happening economically. Number one, we know personal expenditures people spent. So I talked about people have, not only were they given through a lot of different loan programs, $5.3 trillion, they have lower mortgage payments, so they have a lot more money to spend. So people they stopped spending money when COVID first hit, right? We all panicked. We actually couldn't even get into the store. The store didn't have anything. Even if we did get in, we couldn't even buy toilet paper. All of a sudden, toilet paper gets restocked and we spend a lot of money. We all stock up on toilet paper. So we spend a lot of money. You can see these are retail sales. This is growth rates. So we're hoping these numbers actually go negative. Every month they're kind of hoping this is a negative number. And every month we're spending more and more. So we actually surprised. They were anticipating a slight decrease from where it was last month, but we just keep spending more on retail. So even though we're kind of getting all this bad news and economic sentiment is bad, we're all spending more money. Anyone been to the mall lately? Seen the lines at like a Lululemon or at Nordstrom? It's crazy. So people are nervous, right? But they're still spending a ton of money. We know what happens when everyone's spending a lot of money and we don't have enough goods. It drives inflation. So if you look where we are right now, and this is kind of important to understand, so energy is a big piece of our inflation, goods, food, and services. So you can kind of see that. That's what's driving our inflation. So it's kind of a mixed bag. And they're all relatively equal. I mean, they're all playing a pretty big role. So people that think it's just oil, no, it's a lot of different pieces that's driving our inflation. So that's one thing that's interesting. Inflation expectations. So I'm going to break down inflation a little bit, like some of those items, why that's happening. One is expectations. So when people expect inflation to be high, inflation's high. That's one of the biggest things. So if you expect prices to keep going up, prices are going to keep going up. So as a builder, we build a lot of industrial properties, build a lot of industrial buildings. If I think the price of steel is going to go up next year, I'm going to buy a lot of steel right now to stockpile it so I don't have to buy it next year, which means all of us are doing that, which means it's going to drive prices up. If I think prices are coming down next year, I'll probably hold off on buying till next year. But, and this is not just, and I actually think price of steel is probably coming down, but this happens kind of across the industry, across all industries. If you think next year's going to be more expensive, we're going to stockpile now. So you're seeing stockpiles, you're seeing inventories rising quite a bit because everyone's buying, which in turn is rising inflation. So this is a bad sign that we expect inflation to keep going. Another thing is interesting. This actually, so I talked about consumer confidence is tanking. It's really, really dropping. This should be driving inflation down. So this is kind of good. The good news, bad news. What's interesting is if you guys follow the stock market closely, when we get good news, economic good news, the stock market tends to drop. We get economic bad news, stock market tends to rise. I'll talk about, that is purely because the federal government is controlling so much of our economy right now that we're responding more to what they're going to do than the actual fundamentals of the economy. So we're more worried about if they're going to raise the 10-year than the economy is doing well. So it's kind of one of those weird things where good news is bad news is good news, market's all upside down. But consumer confidence, this is kind of good news that maybe at some point people will stop spending so much money. They haven't yet, but hopefully they will. Supply chain issues. So The good news on supply chain, we're actually getting a little bit better. It's still really challenging. We're still having challenges in China. You guys have seen President Xi announce that he's going to continue the zero COVID policy. They want no COVID, so they are locking people in their homes and literally sealing doors shut. They're so really trying to stop COVID by causing all lack of interaction. So factories are shut down, all sorts of things are shut down. So really that's continuing. However, if you look at the Port of Long Beach, we all heard about those ships that are all waiting. We're back to kind of where we were 2 years ago. So the ships are no longer waiting forever. That's kind of working through. So there's kind of a good news, bad news on the supply side. But overall, supplies of good is getting a little bit better. So that's good news. Oil. So we thought we were on the tail end of kind of these horrible oil prices with Russia invading Ukraine. So if you look, USA is 20%. We are the largest oil producer in the world by far. Huge oil producer. Saudi Arabia is number 2 and Russia is number 3. So when Russia decided to invade Ukraine, their oil was at risk. We didn't know what to do. It really spiked energy prices. The good news, bad news is people are still buying Russian oil. So the Russian oil supply did not get cut off. If the Russian oil supply got cut off, we would probably have $300, $400, $500, $600 a barrel oil. So we have placed caps on how much they can sell it for, but their oil is still selling in the market. So we're going to hope that continues. If it doesn't, we've got ourselves a big world of hurt. So when you think about what's happening with Russia and Ukraine, our involvement, all those things, we are still very highly dependent on Russian oil. The Russian natural gas, you've probably seen, is getting shut off. That is shut off, and that's going to impact Europe, especially as things start to get colder. So that'll be a real challenge for Europe. But we saw recently the market was getting back to normal, but we saw recently OPEC, mainly driven by Saudi Arabia, is going to start decreasing their oil output. So again, now oil prices are going back up. So that's bad for inflation. So this I want to look at going forward. So what's the prediction where inflation is going to be? So here we are right here. This is very bad news. Here we're headed right here. So the expectation is that inflation within the next 24 months is going to get back to normal. And what you'll notice is the areas that really shrink are the core goods, food, and energy. Core services stays really high. So what's that saying? Wages. Wages aren't going anywhere, which we'll go through some wage numbers. So we added 263,000 jobs in September. So we're really hoping this comes down to 0 and actually goes negative. We've got to start losing jobs, not gaining jobs. And the fact that we're not losing jobs means wages are staying really, really high. So we're competing, employers across the entire country are competing for the same subset of employees. And the only way to hire them is to steal them from another company because there's not very many unemployed people. And so the wages are keep driving up. So as you think about inflation moving forward, unless we can get unemployment really, really down and slowing down, the inflation number is really going to be hard to drive down because wages are just going to keep that number up. So any questions? I'm going kind of fast for inflation. Inflation is pretty important, and we'll get into why. I mean, the relationship between mortgages and inflation. One thing that's kind of interesting, and I saw Eric walk in. Where's Eric? Maybe he walked in, walked out. He's grabbing food. One thing that's actually kind of interesting, so we talk about why are we hiring so many people? Why we have this persistent labor issue? Eric, this is for you. Why do we have the persistent labor issue? Why is it like we just can't seem to hire enough people? We're always, we have too many jobs and too few people. And Eric was the one that actually brought this up to me first, and I found the research, and it is true. Productivity is tanking. So Americans are working not as effectively as we were a year ago. Why is that? Yeah, we're all working from home. So there is I can't say which streaming service because I actually don't know, but someone that's in the industry told me that one of the largest streaming services, so it's either Amazon or Netflix or one of the others, said by far their peak time before COVID hit was Friday evenings and Saturday evenings. That was when their volume just peaked. Their peak times now, today, anyone want to guess when that is?
Monday, 9 a.m.
Every day at noon. So at noon every day, their viewership is spiking. So what's happening to people at home? They're having their lunch break. Oh, let's watch a movie. I'm going to watch a movie, have lunch. Watch for maybe it goes on for 2 hours. You got a couple breaks. You're having lunch, and it's like, yeah, productivity is tanking. Also, people working from home are not interacting. They're not understanding the company culture. So as these job numbers with the Fed hitting the brakes the way they are, these job numbers are going to tank. In the next 18 months, people are going to start losing jobs. That is going to happen. Fed is doing things that is making this happen. It's slow. It's like driving a huge oil tanker. You can't hit the brakes and have it stop immediately. The things they're doing take a long time to take effect. But the things they're doing now we're going to be feeling it in 6 months to a year. We're going to lose jobs. And who is going to lose jobs? People who are working from home. So this is one of those times if you're, as you're talking with people and friends and family, it's time to get back to the office. Because the first people that are going to be fired are the ones that are less productive and are working from home that employers aren't seeing every day. So time to get back to the office. Is there a question?
Yes. So which are the Fed's actions that are going to drive to unemployment?
So the Fed really, they don't have a scalpel, they have a hammer, and they really have one tool, which is raising interest rates. So that's it. They are raising interest rates. So the fact that borrowing now, so if you think about, an industry I'm involved in heavily, which is industrial development, industrial buildings. Industrial buildings for an Amazon building would sell at a 4 cap. You guys probably understand what cap rates are in here. So maybe a 4.25 cap, which worked really well with interest rates at 3%. So the more money you borrow, the better return you get. Now the interest rates are at 5, 6, 7%. The more money you borrow, the less better that property does. So it's negative interest. So the more interest you have, the worse your property is going to perform. So you're underwater on interest. So that's a huge impact. That's happening not just in that industry, but almost every industry. So when interest rates start to move like that, and you've been expecting a stream of cash flows that's different than what you're going to get, it's really going to impact it. So these interest rates are going to crush a few industries. So that's an easy example in the industrial. It's different in other, but even auto parts, almost everyone in every business is borrowing money at some degree to buy goods, services, supplies. They're having to use the bank to borrow that. Their cost has gone up, and so that's really impacting their profitability, impacting how many people they can hire. It's going to hurt the economy. So high interest hurts the economy, tamps it down, and that's really the Fed's. I guess there's two roles. One, they stopped buying so much mortgage-backed securities. They stopped doing and buying treasuries, buying all these things to keep the market low. But that really is, in effect, just raising interest rates. So that's really their only tool. Get rates up. Make it expensive to borrow. Yeah?
So when are we going to see interest rates coming down?
When do interest rates come down? I'm going to get into that because that's, we'll talk mortgage specifically. So I do want to talk about the dollar. So I'm going to get into interest rates a little bit when I think they probably will come down. I don't know if you guys are following this. So we have massive inflation. We also have a really strong dollar. Seems kind of counterintuitive, right? We're hearing compared to other economies, the U.S. dollar is doing really, really well. So why is our dollar here buying less goods? So here's countries. Here's in 2022 how other economies are doing, their currency is doing relative to the U.S. dollar. I cut a few out. There's a few that are positive, like Brazil and others, but most are negative. You think of Japan, UK, China, all their currencies pegged to the U.S. dollar are doing much worse than we are. And that is because when the Fed's raising interest rates in the 10-year, so the 10-year Treasury, let's say, as an example, the risk of default on the 10-year Treasury is what? 0. There is no chance that's defaulting. If the 10-year Treasury defaults, we are no longer a country. That's the end of our economy. We're all done. So there is essentially, and U.S. is seen as the safest country in the world. So when the Treasury is issuing 10-year bonds, that is as secure and safe an investment as you can make anywhere in the world. Well, if you're in Germany, let's say, and you see the 10-year, the safest investment is now at 4%, that is a safe investment. So money all around the world is coming to the U.S. So they're investing in treasuries, they're investing in all these things. They're pumping, they're trading their dollars for U.S. dollars. So it's made a huge demand for U.S. money, for U.S. returns on these investments, on these treasuries. So it's pumping up the value of our dollar and driving the value of their currencies down. So that's why our currency is going up. So as bad as it's going to be in the U.S., it's going to be a heck of a lot worse in Europe. and other places. So, so we can kind of deal with that. Being the reserve currency of the world gives us a lot of power. It's a really powerful thing, and we're in a really good position relative to the rest of the world. However, on the flip side, as the rest of the world is dealing with massive inflation, because we're a global economy, it's also still going to come back and sting us a little bit. So it's bad news all around. It's better for us than Europe, but not necessarily great news because we're going to have to deal with that inflation. So the cost of goods out of China, because their currency is getting devalued, are going to start to increase. And anyway, it's just not good necessarily all around, but that's kind of what we're dealing with. So we do have a strong dollar. So be grateful we're not the UK right now. So we've talked about the Treasury yields. This is the Treasury this morning, 4.12. This is not good news. Do you guys remember where it was 6 months ago, a year ago? Actually, you can see. So let's go, October. So if we go like back, we're right here. So that's 1 year. So we're at 1.5%. So how much have we gone up? Like 2.5%, is that right? How much have mortgage rates gone up? More than 2.5%. So that's one of the things I want to talk about. So mortgage rates, the gap between the 10-year and the mortgage-backed security has grown at a much faster rate than even the 10-year has grown, which is a problem for all of us in this room. So the mortgage-backed security has gotten much more expensive relative to the 10-year, and this is showing the gap in across the last 10 years or 15 years, showing the gap between mortgage-backed securities and the 10-year. And you can see when it spikes, this is the last recession we had, the big one, and it spiked up to about a 3.5% gap. We hit it again during COVID first hit. We got back, and this is when the Fed started buying mortgage-backed securities, drove it back down, and now we're back up. So the Fed stopped buying mortgage-backed securities. We know that. But there's other things at play too. So this is maybe getting a little inside baseball, but one of the reasons this goes up, so mortgage-backed securities, what's the risk when you buy a Fannie and Freddie mortgage-backed security? What's the risk of default on those? Pretty close to zero. If you think about it, when they were privatized, the risk was actually relatively high because Fannie and Freddie could default. If everyone had their mortgages collapse at once, we'd be in a bit of a problem. Now that the Feds own Fannie and Freddie, the risk of default, again, is pretty close to zero. So why is the gap bigger? The gap is bigger because unlike a 10-year, that you're in for a 10-year investment, you buy a 10-year Treasury, you are getting 10 years of payments no matter what. There is no scenario where you don't get 10 years payments. What happens in mortgage-backed security when rates drop 5% or drop back to 5%? Refinancing, right? So you have, and these are buyers that are buying these pools are buying billions. So if you bought $1 billion of mortgages at 6.5% and rates went to 4%, you just got repaid on a big portion of our portfolio, and now you have to go out and reinvest that money at rates now that are at 4%. So it's cost of capital, it's expensive, so it's just easier for those people to buy mortgage-backed securities and know it's a much steadier stream. So the risk of refinance is kind of what's driving that number. So that good news, bad news on that is it means most investors think that rates are probably going to come down. So that answers your question. You notice these don't stay up here very long. I mean, this is a couple years, but at some point they get this high because they think the rates are going to start dropping, and they're going to have to redeploy money. So it's kind of one of those good news, bad news. It's high right now because there's a big risk that the market is going to turn, that they're going to have to start lowering interest rates and deal with that and deal with redeploying money. So the bad news is we just have really, really high interest rates. So that, as you think about what the Fed's doing, so they have the brakes on the economy. They want to hit the brakes and take them off just before we hit a recession, right? That's kind of their goal. It's right before we hit the recession, take the brakes off and hit the gas again, or whatever it's going to be. Maybe they don't hit the gas, but just take the brakes off. That balance is really hard, but the market's basically saying at some point, we know the Fed's going to take the brakes off. We don't know when that will be or what that's going to look like, but they're going to take the brakes off. They'll likely, at this point, the market's kind of saying there's almost 100% certainty we're going to go into a recession, which means they're going to have to put on the gas again. So we're going to kind of be in that. And if anyone ever taught a 16-year-old how to drive, we're going to be doing that a little bit, where it's like not steady, not smooth, but kind of jerky. And so we're going to be in that, I think, in that scenario. And I think a lot of people think that maybe the Fed's going to start lowering interest rates, maybe buying mortgage-backed securities, doing that kind of stuff. where again, we'd all be excited for a couple years. This time we'll maybe save our money a little better. But that could happen. The market's the market's not perfect, as you know, but it's predicting, and that's kind of what it's predicting right now, is that's going to happen.
About recession?
Yes.
I'm really confused because I thought we hit a recession.
We did.
It's just not admitting it. So can you speak to that a little bit?
So there was, I think it was in the 90s, whatever, or 80s or 90s, they basically didn't have a real term for what a recession is. Some economists got together and basically decided 2 quarters of negative return would be the equivalent of a recession. And so we did hit that. We hit 2 negative. They were close to negative. They were kind of right on the border. We absolutely, by that term, hit a recession. There were other scenarios that kind of played into that overinflated some of the negative numbers. There was a big piece of that was an increase in how much we exported versus how much we imported. That kind of skewed the numbers a bit. So the Biden administration obviously wanted to avoid the appearance of inflation, just kind of said those numbers skewed it so much that it really wasn't a negative quarter. It was a growth quarter. Anyway, it gets complicated, but they didn't want to admit it. Technically it was, but most people in the market kind of like it was a soft recession, if anything, back to positive growth, so they're not really counting it. This one, if we hit it again, will be more significant. So that was kind of the argument, but technically we did hit it.
So when you say more significant, are you talking like 06?
I don't think it's going to be anything like 06. So the housing market in 06, and I think it's important to talk about, is very fundamentally different than what we're dealing with in this housing market. I'll actually get into some of the numbers on that, but I don't think we're facing anything like we are in 06. There are challenges without question. This is not fun, but the fundamentals of the market we're in, especially the housing market, are still very strong. The one thing that's gotten out of control is just affordability. So you take affordability off the table, we get back to a 5% interest rate, and we have huge pent-up demand. We don't have nearly enough housing. The market's back roaring again. In 06, we did not have that. We did not have the demand. We had way too much supply. We had supply-demand upside down. This time, I think we're still in a good supply-demand issue. It's just price has gotten too high. Again, this is showing the change in 30-year mortgage rate. So we just had a huge spike. You can see it's never grown this fast before. So one thing consumers don't like is sudden change, and we had very sudden change, very fast change. I would suspect that if it took us 3 years to get 7% interest, none of us would really notice that much. I mean, the expense would be up, but the fact we did it in a couple months, it really hurts. And people are very uncomfortable. Mortgage payments, for example, kind of went from that average of $1,700 to $2,300. And let's see. Oh, there's a slide I cut out somehow by accident. I'm really bummed about it. There's a really cool slide that I had in here, but it might pop up later. I may have just moved it. So let's see. I'll see if it pops up later. But mortgage rate, so that the cost to own a home has just gotten very, very expensive. People simply can't qualify. So moving off of kind of the financial data real quick, I think it's important to understand demographic data. So demographics in the U.S. are also changing very dramatically. And not in a good way. So population growth was one of the things that we care a lot about in this room, population growth, new households formed, all that kind of stuff. Population growth in the U.S. is almost at 0. So we've done a really good job of eliminating legal immigration, which I think is horrible. But we've really tamped down on how many legal immigrants are coming in the United States, which is bad. We have more illegals coming in, not as many illegals. And so it's really kind of having a big impact. In terms of employment and a lot of other things, but anyway, I'll try not to get into that too much. But population is not stagnant. We're not the same across the entire country. It's very different. The red areas here are showing where population is decreasing, and the blue areas are showing where population is increasing. So you really, as a realtor, don't want to be in the red areas because it's going to get harder and harder. Prices are going to be coming down. You really want to be in these blue areas. And some of these areas, I mean, you can see some of these areas are so small. I mean, we're talking populations of like 10 people, so it doesn't really matter. But some are really big, like this. Massive population movement coming out of Northern California. Southern California continues to grow for the most part. Northern California, a pretty massive exodus. Some of these areas, in the east are also really big. And what you can kind of tell as well, People are moving from higher tax states to lower tax states. That's happening kind of around the whole country. But even though the population is stagnant, there's certain areas that are really seeing explosive growth, including Utah. So these are the fastest growing states. California, you can see, is negative, all because of that stuff in San Francisco. But Utah is the second fastest growing state. So it's really the Mountain West, Texas, really seeing positive economic growth. This is a no tax state, no tax state, no tax state. So people are really drawn by the tax rate, and the economies tend to do better in those states. Utah population expected to continue to really boom, which is good news for all of us in this room. So really fast growing population. And one of the things that's really important, one of the biggest indicators of future economic growth is the age of your population. The younger you are, the more likely you are to have population growth, positive economic growth. And Utah has its own color. So we are the youngest state in the nation. We have a lot of babies. And so we're a very young population, which is really good. So Utah, if you look at nothing else, this is really important to understand. Utah will be economically successful because we have a young, vibrant population and workforce. That is very important. When you have an old population, that's really, really damaging, especially as you think about countries. So the U.S. still has a relatively young population, not compared to some countries in Africa, but in terms of developed nations, it's very young. One of the countries that's really going to struggle here is China. So China has a very old population because of their one-child policy. They're trying to get out of the one-child policy right now because it's eliminated almost a whole young generation. The population's aging. You think about the safety net that's going to be required for the young population. It's almost going to be one working population person for every person that's retired in China coming up. So that'll be a challenge for them economically. One of the areas they're trying to solve that with is in robotics. So you'll see China's really investing heavily in robotics because they know they have a massive population and workforce problem. So they're going to try and replace a huge portion of their workforce to pay for their older people by implementing robotics. So that'll be interesting how that plays out. So we're going to talk more in terms of Utah, or in terms of housing, what's happening in the housing market. So there's a question about 06. So what this is showing, when you're above this kind of line, you have a housing surplus. When you're below this line, you have a housing shortage. So we are, and this is kind of that 06, 07, we built way too many houses. We didn't have the demand. We gradually worked through that. Builders stopped building for a while, and if you guys remember that, you couldn't get a builder to build a house to save your life. And then all of a sudden, our population started to boom. People were moving out of their parents' houses. People were getting divorced, all these different things that create new households, and we didn't begin to have enough housing. And we're still in that situation right now. We have a massive housing shortage. The problem is you also have a massive affordability problem. So even though I'm looking for a house, I can only afford a $300,000 house. I'm essentially out of the market. I'm not moving into a house because there's no such thing as a $300,000 house. So I'm kind of in that limbo where I can't afford anything. I'm probably renting, but even rental rates are skyrocketing. So it's just gotten really hard. So a lot of those people are having to stay at home or not move out of housing. Oh, I did find the slide I was trying to find. I moved it in the wrong spot. Households, this is again showing, you can see the red bar is households that are being formed. The blue bar is net addition to the housing stock. So we were adding too many houses in this area right here, and now we have what we have now is a massive housing shortage. Having said that, what you'll see, I think next year is the households formed is gonna really shrink this year. Because people can't move out, they're staying in their house with parents, they're figuring out a way to kind of make life work. So household formation, I think this next year is going to be relatively light. Having said that, I still think we'll have a massive housing shortage, and if we can somehow crack the affordability or lower rates, we'll see that tick back up. This is what I want to show you. So how much money can you buy with $2,500 monthly mortgage payment, assuming 20% down payment, 30-year mortgage? It was So I think it's probably January, February of 2020, $758,000 house with that payment. Today, $476,000. So same payment, very different house. So if you think about what those houses look like, in this market anyway, that is a very different house that you can afford today. So again, we talk about the market, it turns so quickly. We're just in one of those areas where people are stuck, they're frozen, they're scared, and really having a hard time figuring out what to do. I'm going to skip this slide. Housing affordability. So this is just showing affordability levels. This is how much of your income is going towards housing. We're at that 33%. So it's a really, really challenging issue. Eric, I'm going to make you talk in a second, so you better not leave. Your slide's in here. Your slide's in here. So affordability, again, affordability is just deteriorating. It's getting worse and worse and worse. It's getting harder for people to afford housing. This is showing wages are growing. We've talked about wages growing. They're growing too fast. It's nothing compared to what's happened to housing, especially as you factor in the interest rates. So not even close to keeping up. Predictions. This is a group, AEI. They do a lot of housing studies. They focus a lot on that. This is what they're predicting. What's crazy is we're still at a really, compared to last year, compared to housing last year, we're still up 11% from where we were last year. So when we talk about seeing some housing drops, if you rewind a year, we're almost, most of the worst expectations we're going to drop 10, 15%. That's basically putting us back to last year's prices. So in the grand scheme, not a huge deal. It's basically losing 1 year of insane growth is going back to last year. So the anticipation is this is going to continue to drop as months go by, get kind of that 0% growth and hit zero and probably stay there. So we'll see almost no growth from last year. We'll eliminate the 20% we had, from last year, or 15%, whatever that is. That's probably going to be eliminated. But we're not going to, predictions right now, and I've read, 15 different ones. The worst one I think was 15%. Some of them were 8, 5, 7. Some of them were actually positive. This year would be positive. So the worst I saw was about 15%. So we'll be back to where we were last year. Not terrible news, unless you bought 2 months ago. Yeah.
So going back to affordability, slides back.
Yeah.
Are you thinking months or are you thinking years?
So I think my prediction is somewhere between months and years. I don't think it's 2 months. I also don't think it's 2 years. So my prediction is, my thought anyway, it's sometime, I originally thought it was going to be before the election because there's nothing that hurts the incumbent party more than a bad economy. But the Democrats have done a relatively good job, and the Republicans have helped them a lot to take everyone's eye off the economy and added some other issues that people are talking about that are more important. So they're kind of forgetting about the economy. So there's a lot of politics into that. This is an election that Republicans should sweep. Every House, every Senate seat should dominate, and historically they would. But Democrats have been good at raising other issues that people are caring about. They're more important in their mind than the economy. So it's it'll be interesting to see how this plays out. Having said that, Biden's election is when? 2 years? So the Democrats, so that's the big one. In 2 years, they want this economy humming big time. So to have the economy humming in 2 years, when do you need to hit the gas? A lot sooner than 2 years. So and the government's playing such a big role. So my prediction is because of that, because they're looking forward to making sure, and I don't know, you guys are recording this, whatever, but I don't think Biden will be the nominee for the Democratic Party. I think it's highly unlikely. I think perception is that he's senile and out of touch, all that kind of stuff. The funny thing is people that know him well say, well, he's not senile at all. He's been this way for 40 years. He's always been, they're like, it's exactly the way he's acted for the last 40 years. I've known this guy forever. He talks like, it's how he's always talked. So for us, it's like, man, this guy's out of it. But it's like, that's just who he is. He's, but I don't think he'll be the nominee. We'll see. I don't think Kamala Harris will be either. I think it's going to be someone entirely new. But that's just a prediction that's probably not going to, who knows. But the Democrats, the administration that's in now, will want the economy humming well before that election. So that's the next goal.
Going back to the question, is it more closer to 6 months to a year, you think?
I would think 6 months to a year. It's really hard to say. It really depends. So what you're going to have to watch is the jobs numbers. I think it's the most important number to watch. If the jobs numbers doesn't get worse, if we don't start seeing jobs go down, they're never going to be able to stop and pull off. Because inflation sticking around will be the worst thing that can happen to our economy. It can stick around for a decade. We've seen stuff like that happen in the past. They need to have job losses in a big way. So what I think the most important data to look at, if I were looking at anything, is jobs data. And when we start losing jobs, that's when they're going to know they're having an impact, they're having an effect. And at some point, when we have unemployment around 4 or 5%, they're going to be able to start hitting the gas again. So, but the job numbers continue to surprise us every month to the upside. So it's one of those things we really don't know. I can't predict. I would have thought the jobs we'd already have job losses by now, but we're not seeing it. So yeah.
So I think the conversation that we're all having right now is, look, prices are high, but to get in, you're going to have to bear this mortgage and then we got to fill in the blanks. 6 months to 2 years.
Yeah.
Plan on doing a refi. Can you handle that? Is that accurate?
So I think it's a really good point. I'm going to have Eric talk to that more specifically. You know what slide's coming up. But we don't have a crystal ball. We don't know. But yeah, I would think, I'll actually show you some numbers I think will kind of help. We have a time frame where it's like if they don't get down by then it's a problem. But let me just, I'll
Josh,
get into it.
in the short presentation that I'm going to do for all the real estate people, you're going to see something that you've never thought about, and it is going to change your attitude and the way you talk to your buyers, because there's actually a very, very big opportunity right now, and I'm going to show you, and once you understand that, you're going to do two things. You're going to sell a bunch more buyers, and you're going to help solve the issue of housing, of homes staying on the market a while, so just stay tuned, it'll be short. I've done this presentation half a dozen times in different offices around the country, and the people that understand it, and my team as well, it's just a completely different way of looking at it. And then Bert has a spreadsheet or an Excel thing that he's got that he's going to show you that you can actually
I'm have Bert do it then. You have that spreadsheet?
Buyers.
I'm making you go through it.
Yeah, to show you, your buyers.
I'll go through it.
Raise your hand if you think it is better to buy right now today than it was 9 months ago or 12 months ago. Oh, yeah. Absolutely, right? So we need to share that with our buyers. And when you see this short presentation when I'm done, or when Josh is done, you'll understand it.
I might be stealing your thunder a little bit because I have something coming up, but I'll try not to. I'll go lightly. But I do want to say, David, I appreciate the invitation. This is really fun to be able to speak to all of you. You've built something here with EXP that's incredible. You've grown really fast. This is not, especially the time you grew, was not easy. That's probably the hardest time to grow a company, is when things are good. The best time to grow is right now, believe it or not, because people are looking for direction and leadership. And so I'm excited about what you're going to do for the next year. And I think you'll have incredible success. So I appreciate what you're doing and for allowing me to be part of it and come up and speak to you. So thank you. So this is, so Case Shiller is basically saying, so talking about housing going forward, they think it's going to drop 7% next year, which gets us back again, still higher than last year, but expectation it could go as low as 15. But they think anyway, it's short-lived. It's 1 year. So we'll see how that plays out. That's just housing price. That's housing price index. So where housing price is going, we went crazy at 20% for a couple years. It just went completely bonkers, and now we're paying the piper. It's gonna drop. But builder confidence. So builder confidence is tanking. I do a fair amount of residential development. Builders right now it's really hard to get them to invest and buy. They're finishing out existing stuff. So tradesmen are still busy with projects that were started, but we're not seeing builders start a lot of new stuff. So that's going to have a real impact going forward in terms of housing stock, because again, we're undersupplied. And when builders are scared and not building more stuff, because they can't sell it, I mean, I understand why they're not doing it, but the undersupply issue is going to get worse, not better, looking forward. So keep that in mind. Particularly in Utah, we have a huge population growth. Builders aren't building; they're going to slow way down. We were barely catching up to where we needed to be. Now they're going to slow down. So think about the impact that's going to have in Utah. Is there a question?
You answered it.
Oh, there we go. So price reductions are increasing. We know that. Wholesales are dropping. What's crazy is, and this is actually a little bit low, I think it's more in the 20% range now, but if you talk to people on the street, you'd think housing has dropped 80, 90%, right? Like no one's buying houses. And it's like, no, it's dropped, but it's still relatively healthy. And if you compare it to some other years, we're not that far off of 2015, 2014 numbers. So people are still buying houses, which is crazy considering we're at 7% interest rate, right? So why is that? We'll get into why I think that is right here, which is exactly what David said. Is it better to buy now or 2 months ago? So is it better to buy in a high interest rate, lower price environment, or a higher price, low rate environment? And it's significantly better to buy right at a lower price, higher rate. Now, if you don't refinance out of that rate for 30 years, the math does flip. So, do you want to go through it? Or do you want me to? Oh, Bert, do you want to go through it? I made my own numbers here. So before Bert comes up, I do need to. He's going to hate this, but I got to say something about this guy. So Bert, how long have we been working together? Like 4 years now? 5 years? Bert is one of the most capable loan officers I've ever met. So to be a successful loan officer, you got to have two things. One, you got to work really hard, and we know a lot of people can work really hard, but you also have to be really smart. Loans are incredibly complicated. In fact, I'm not sure I've ever seen two loans that are exactly the same, because there's always something crazy that one of your buyers has done or is in their past that is like, man, we've never seen. I mean, at least once or twice a week, it's like, I've never seen something like this before. How do you even figure this out? So the key when something like that happens is having someone who not only works hard, but is crazy smart. So Bert's crazy smart. He has grown in the last 10 years. You're probably one of the top, I guess, top 10 builders or top 10 loan officers in the entire state in terms of volume, in terms of purchase volume. So he's done an incredible job, one of the greatest loan officers in the state, and someone I'm lucky to be able to work with. So if you haven't had a chance to work with Bert, please do. Send him a loan, test him out. In fact, I get to take home all the leftovers. So when you get a really complicated deal that your broker can't figure out, call Bert. He's going to figure it out like that, right? He likes the hairy ones. So
well, and to add that, our team, we've sold over 3,000 properties here in Park City in our career in 22 years. We have never met anybody that works with buyer or with purchase than Bert. He's here because of proving his ability to close deals for us, and he's earned it. And if you're on our team, everybody knows it. So, but don't all of you change to him. So I don't want don't everybody change. Right?
He can handle it. I've never seen a guy willing to work so hard. I mean, he really is. And there's been some issues where we've needed someone that could come in and work his tail off, and we've had Bert come do it, and he's done a really good job. So, do you want to go through this later with David? Should I just skip the slide and go through it later? Because you guys are going through something like this, right?
Yeah. Well,
I'm going to skip the slide. I'll just leave it kind of at that. Yeah. It's not a bad time to buy.
Well, okay, so what we're going to show you, and we're going to give you a copy of this. If you check the box, we're going to give you this spreadsheet to use with your buyers right now. And what's really good about it is it's interactive. And my son, Drew, who I've been trying to get him to come and work for me. Brian knows him for like 6 years. He was the marketing director in Orange County at TechMD, and he is so analytical. And I used to think that I was a pretty good salesperson, but he told me no so many times that I was losing my confidence in the ability to sell somebody. But 3 months ago, he looked at the EXP model with me, or 4 months or 6 months ago, of when we were thinking of changing. And after he did this spreadsheet, it told me, oh, we should move, right? And we should do it. And then Bert and Drew and I, mostly Bert, has put together this. And this is just, it's an Excel spreadsheet where you guys can put in your numbers. What was the mortgage rate then? What is the mortgage rate now? What is the difference between the purchase price? What is the down payment? Is there an appraisal gap? And so on. And you're going to see this in the presentation. But it's one thing to know it, but it's another thing to be able to show it to your clients and your buyers. And when you do this, your buyers are going to be super excited to buy right now. So.
Don't show it to anyone from a year ago.
Yeah, so I'll let you go through in a minute. So, but I did want to make sure to spend some time on Bert because he's a talent. I'm lucky to be able to work with him. And there's been a lot of guys who try and steal him from me.
But what you can see right here
we're
is
best friends.
In this model, if you can see up here, to buy now versus a year ago, the time to recoup is 5.21 years. And I can tell you it's actually more, and you're going to see why.
I've been really conservative on these numbers. I went really conservative on these numbers, and I think it's much more. So basically what this is saying, in a really conservative base case, if you refinance in 5 years, you've made money. So it's significantly better than that because I went really conservative. So, but I'll skip that and just go to kind of a few takeaways. One, housing sales and volume are slowing despite housing shortage. So we still have a housing shortage, but we know sales are slowing down. One of the things I do want to touch on real quickly with Utah, I don't have it in the slides because I've talked about it in the past, but some of you may not have thought about this in it as much as I have, and that is that Utah is unique. We're not Denver, we're not Phoenix, because those cities can grow in any direction as far as they want. Utah is really limited in terms of where we can grow. We have 75, 80% of our ground is owned by the federal government or state government, which will never be sold and never developed. We have mountains that really restrict where we can grow. We also have a really dramatically changing city council government in almost every little city around the state, and they have become very anti-growth. And we've seen that time and time again. People are tired of the congestion, the populations. They've become very anti-growth. Which is really going to restrict housing stock coming forward. We've talked about builders building less right now. We have a water shortage. So there's going to be certain areas, particularly in southern Utah, that at some point will say we are completely out of water rights and we're done. We're not building any more houses. So that will start to happen in the next 5 years or so. Maybe a little longer now that things have slowed down, maybe 10 years. But all that with an increasing population is saying housing in Utah is going to be a rare commodity, which is telling me prices are going to go up. So it is a really safe market. It's a really good market. It's not going to go up steadily. There are going to be times where it drops 5, 6, 7, 10%. That will happen. But if you look at the long run, it's like a stock portfolio. If you want to try and time the market, you're probably going to lose money. But if you're in it for the long term, even if you bought it a year ago at kind of the worst time, you stay in that house 4 or 5 years, you're still going to make money. So that is going to happen. So it's just, we are so restricted. This is just a really solid market. But the rate, so we're talking short term now. So we're talking short term decline in housing prices, not long term. So the rate and severity of the decline is going to depend almost entirely on mortgage rate, right? So right now we're seeing the demands there. It's just mortgage rate that's killing us. Mortgage rates are determined by inflation, which is determined by job growth, oil prices, market uncertainty, all that kind of stuff. But really, I talked about job growth is going to be the key. So if you're looking at anything in the news, start hoping that, it's really sad, but you kind of start hoping people start losing their jobs. That's what's going to allow us to get out of what we're going through. That's our only hope. I can never run for politics now because I've said that, but it's true. I talked about work from home. I think work from home is likely to come to an end. Labor market softens. It's going to really affect, especially if you think about certain markets. Markets like Park City, I think, are going to be more impacted than other markets. But Salt Lake as a whole is probably more impacted by work from home. So if you think about a lot of people moving to Deer Valley or Park City, working in New York City, that's going to be a harder lifestyle to maintain going forward. So I think it does open up some inventory in Salt Lake or Park City. Other rural markets, Jackson Hole, those types of areas, I think are going to be more impacted than others as people are forced to go back and work from the office. But long-term outlook in Utah is very upbeat. I am very, very bullish on long-term housing in Utah. I think it's going to do very well. And everything that's kind of playing right now is just building this huge tsunami of demand. And it's just, we're going to have another experience like we had 2 years ago, which is telling me, and I talked to David about this a little bit, or just saying to David, where it's a good time for him to grow. It's also, as you think about your pipeline and what you're doing, even if you're not selling a ton of houses right now, this is the absolute best time you can possibly have to develop new relationships, new contacts, all those things. And right now is when you make all the money you're going to make in your career is during downturns. And you'll realize the money, you'll actually get the cash when it turns up. But right now is when you make it. And so if you think about what you can do right now, this is a really important time because other people aren't going to be doing this. They're not going to be reaching out to past clients. They're not going to be staying in touch. They're not going to be developing those relationships that are really important to be developing right now because it's easier right now. When the market was crazy and hot, it was hard to get into offices. People didn't want to talk to you. They were so busy they didn't want to deal with you. Right now, it's really easy to go in, develop those relationships. Reach out to your sphere of influence, your people, like any kind of network you have. Now's the time to be developing that because this market is going to turn and it is going to get crazy again. And if you spent a year doing what no one else is doing and building that pipeline, you're going to be in a position to really realize that. So look at these downturns. They're painful. I know it's hard. Some people are having a hard time paying their bills. But look at this as a real opportunity, an opportunity to take advantage of what other people are not doing and really get ahead. You're not going to see the cash till it starts turning, but when it turns, you'll recognize all the investment that you made. So I would just say I think the market doing this is good for people who can think ahead and strategize and understand what's happening in the economy. It is still, having said that, it's still possible to sell houses right now, as we know. Market's only down 20% of sales. That's not a big deal. There's still a lot of houses to be sold. Inventory's picking up. It's still a pretty unique opportunity. And David's going to show you that the pricing is actually not that bad relative to where we were a year ago. So with that, any other questions?
Couple things I want to add. In the 2020 census for Utah, they said we were 50,000 units short of inventory. Over the last 2 years, they said it was getting closer to 40,000, but it doesn't matter. We cannot build 40 or 50,000 more homes. Can we build 40 or 50,000 more homes?
No, especially when builders stop building. So builders are stopping. They're really slowing down. So we're creating, like I said, we're creating this tsunami. So we have the backlog. We stop building. We're kind of doing all the wrong stuff. We should be building like crazy. Well, not right now, but wages should hopefully start coming down a little bit. Prices start coming down a little bit. So it's a time we should be building. We won't be. Builders would be too scared. So it's going to go from 40 to, I've seen those same numbers, 40 to 50,000 to who knows what kind of shortage we'll have.
Yeah. And think about it. It's all about supply and demand. I was a business and economics major in college. No, that was a few years ago, or a few decades maybe. I don't remember much, but I do remember this thing called supply and demand, right? And in Utah, I believe, and it showed here on some of the slides, where the other markets prices are really going down. I don't think it is going to be nearly it's not going to go down as much here. Anybody have any idea what Zillow is predicting 84060 or 84090 to do in the next 12 months? Anybody? Not on my team, don't answer. You should know. Okay? They're saying that they're predicting that it's going to be between 2.1 and 5.7%. Which way? Up. Okay? So, that's just another thing to be thinking about. Supply and demand is everything.
So I think I hit my hour,
Yes.
3 minutes short.
All right.
But
Any other
questions?
Any other questions for Josh?
I had a quick question.
Yes.
People always ask me, when are homes going to go back to 300,000? And I said, they're not. That's going to change the demographics of people that live here. And that's a reality, and it's a hard reality, but I live in California. I mean, it's where we are.
Yeah. So the only way to get prices really to lower is to have massively high dense projects and have costs come down a little bit, land costs come down. So that could happen a little bit. We could see a little bit more affordability, but it's going to be a very small unit, very high dense. But we're not seeing communities that want to do that yet. So
Well,
we'll see
the
if we have it.
research that I read in Utah is, you know what the solution is? All of us need to move out. If we move out of Utah and take all of our friends and all of our families, that's the only way for us to get back to a supply and demand that is evening up. And I don't know about you, but I'm not in any hurry to move out of here, right? And you know, and what is the growth predicted in Utah versus any other state? I thought it was number 1, but I was wrong. Josh
Idaho
just told
beat
me
us,
it's number 2.
But yeah,
right
but
on
barely.
that slide.
Yeah, but Idaho's a much smaller population. So, and in terms of actual numbers, we're still like behind Colorado and Arizona. They kind of dwarf us, but in terms of percent, we're beating them. So, with that, thank you guys. It's been a real pleasure. Bert, again, get Bert your email. He can send you all the slides, and happy to answer any questions. But that's it. Thank you. Appreciate it.
Thanks for watching, and I hope you enjoyed this presentation. If you have any questions, please drop a comment below or reach out to me personally. And please, don't forget to like, comment, or subscribe, and we'll see you next time. Thanks.